this is a real shock to the system. And I do believe we will see the ramifications in many ways. We're seeing housing shutting down. And I think we're going to see a lot of other activities shutting down as well. We believe we're in a recession, and we believe this recession now will be sustained. Gold is a leading indicator of inflation, and it has not broken out. It is breaking down. And then the second thing that we're looking at is the inventory glut around the world. And especially in the United States, it looks like some of the best supply chain managed companies in the world over-ordered. They ignored their automated enterprise resource planning systems, so ERP systems, and double-ordered, triple-ordered. Well, what's interesting, I think many people are coming around to the idea that we're in a recession or we're going into a recession. The first 2 quarters with real GDP growth negative to us means we're in a recession. And now that many people are worried and are beginning to see recession for as far as the eye can see, we are looking at this recession a little bit differently. We think it's going to be a function of this massive inventory overhang.
I think the same thing now. We've had this incredible decline. We have so many more problems now. Supply chain, Russia's invasion of Ukraine. Innovation solves problems, and yet these algorithms and very short-term time horizons. Ours is 5 years. The market in risk-off goes to 1 quarter. Algorithms are dominating the market. It's very interesting. Most people don't know what our companies do, and they don't know the kinds of problems they are solving. Inflation is the problem, and might remain the problem. We actually think there are signs all around the world that deflation will be the bigger problem.
So job openings are declining. We're also seeing surveys out there. I think in the US, among major employers, 300 have announced layoffs, and that's reflected in something called the Challenger Layoff Survey. And those layoffs, which are broad-based company layoffs, are up 68% year over year. I would also imagine that they would consider leading indicators, which in every recession and recovery, in my experience, the Fed has paid a lot of mind to. It dropped 0.3% in the last month, and that makes for 5 consecutive months of decline. And the rule of thumb there is once you've got 3, you know you're in a recession. I believe the velocity of money now is going to start falling again. It actually peaked in 97, has been falling. It falls at an accelerated rate during crises. And if the velocity of money starts falling now, that M2, it looks like M2 is going to come in below 3% year over year for September. If velocity is falling on top of that, that means nominal GDP growth is flat to negative on a year-over-year basis. That's a killer for companies' profits. Now, in this environment, the reason why we would start outperforming is because our fundamentals are better. We're the new world. Our revenue growth is much stronger than GDP, and in times of turmoil and trouble, again, innovation solves problems. The negative is we're going to lose our competitiveness. And so we're already seeing trade drop off quite significantly. And I think that's going to be, we believe we're in a recession, and trade's part of the reason. Now, interestingly, in the third quarter, if we see a positive GDP, it will be because trade is collapsing, meaning imports falling much faster than exports. And so that helps our GDP in a strange way. And the reason it's happening is we have an inventory glut.
The other thing that's going on, and it's been interesting to watch the surprise around the dollar's increase, 25% in the last year. That's another powerful inflationary, anti-inflationary force. So
in this country anyway.
In this country, but what the problem in the emerging markets, it's crushing them. Why? I remember, I've been in the business for a while, as most of you know. In the early 80s, the dollar did the same thing in response to monetary policy. And we ended up in the Plaza Accord and the Louvre Accord, where all of the treasury ministers around the world, including our own, decided to sell dollars and buy those other currencies because that dollar increase was becoming deflationary. We are somewhat myopic, and we are the strongest economy in the world, but it's going to come back to bite us if we're not careful.
How much research has disintegrated in our industry, and that is a real problem if we're talking about efficient allocation of capital. You know, these benchmarks and indexes are all backwards looking. The biggest stocks and companies in those indexes are there because of past success. But if we're right, and this is why I founded ARK, and we're going to see more disruptive, truly transformative innovation over the next 5 to 20 years than we have ever seen. It dwarfs even telephone, electricity, automobile. Those were 3 platforms at the same time. We have 5 brewing now, and they involve 14 different technologies, all of which are growing exponentially. So if we're right, then the traditional world order will be disrupted, and those indexes are not going to be a good place to invest. Now, what I'm fighting here is history, because as that 20-year phenomenon took place, it became a self-fulfilling prophecy. The more people investing in indexes, the better those indexes did around stocks. No, it's mine. No, it's mine. Well, there's going to be a lot of that in the innovation space because of all of the convergences between and among the different technologies. So I think the surprise to me is how long it takes traditional Wall Street to catch up. And we need the whites of the eyes of surprises, earnings surprises, revenue surprises, unit surprises, share gains. And even then it takes a while. So but I always say to our team, and I think what inspires me every day is our analyst team. You know, they're coming up with new ways of looking at the world. They have one foot in the new world, so always bringing in new ideas.